right? Like even if the mod makes absolutely no sense, and for any like a mod that raises the payment, like why would you do that?
Yeah, I saw one of the examples you pulled. It was like it looked like that put somebody in a worse situation. Seems to start at like 50% DTI and then go up to 57. So
yeah,
maybe you could tell us a little bit about your background and what made you interested in this.
Sure. So I've worked in the mortgage technology industry for better part of 2 decades. Most of that time with Black Knight / LPS, which is now ICE, and also a chunk of time doing consulting for some of the largest originators and for some of the government agencies like the VA. Done some extensive consulting with them on some of their systems. So I'm kind of naturally familiar with the subject matter. And for as long as I've been in the industry, I was not aware that Ginnie Mae and then Fannie and Freddie as well, though they release every month at a loan level the performance data on all of the loans that are in the MBS pools, which is not every mortgage out there is in an MBS pool, but the significant majority of them are. Like with respect to FHAs, the data set that I track, it spans about 87% of the insurance in force loans. So it's a really good representation of what's happening, but it's going to be a better part of the portfolio because loans, scratch and dents, they don't go into the pool, and loans that go delinquent they have to make on them, and then if they need to do loss mid, it'll come out of the pool. Usually it'll come back into the pool as a mod or something because the servicers want the liquidity. But in any event, it gives a really, really good look as to what is the kind of the front lines of what's going to happen, right? And so when I discovered that this data was out there, I started pulling it all in locally so that I could kind of slice and dice it to figure what really is going on in the FHA portfolio. The headline delinquency rate tells a story, but is that the full story? And it turns out, no, it really isn't. So that's kind of my rough background, unless you have any questions.
Yeah, I was a little surprised, this Ginnie Mae data. After reading our article, I signed up with them, and it's available to the public. Brave enough and wants to dive in there and look at it. Are you looking at the loan level pools or?
Yeah, 100%. Yeah, specifically the Ginnie Mae 2 pools, which is like 95% of them. Eventually, when I've got the time, I'll go and pull in the loans that are in the Ginnie Mae 1 pools as well for completion's sake. But the Ginnie Mae 2 pools dominate.
Right on. And the last couple of years, we've been kind of, at least in the industry, it seems like there's been sort of this rosy picture, like a foreclosure are at an all-time low, or at least 2019 level. The risky loans aren't at any. Yeah, I'm curious how you think. It sounds like it may be the government's intervening here, and if it wasn't for that, the foreclosures might be worse. Right?
100% off effect. Like, I mean, with respect to the FHA mortgages right now, FHA's loss mitigation procedures, and in industry lingo, you'll typically refer to as the loss mit waterfalls. The waterfall of options that a servicer goes through with a borrower, from like least impactful, most impactful being like a modification. But they go through a series of steps, and those steps are largely prescribed for FHA insured loans by the FHA. And that waterfall, those loss mit procedures have been incredibly loose over the past 4 to 5 years, really since. And with respect to foreclosure, you basically as a borrower more or less have to tell the servicer, look, man, I'm not going to pay my mortgage, do your, or you have to completely ghost your servicer to not get a mod, right? Like even if the mod makes absolutely no sense, and for any, like a mod that raises the payment, like why would you do that?
Yeah, I saw one of the examples you pulled. It was like, it looked like that put somebody in a worse situation with the loan.
That's the tragedy of it, right? When you do a loan modification, because in a loan modification, they have to reset the interest rate. So if you got your loan back during the pandemic and it was, say, 3%, 3.5%, and now market is 6.5%, 7%, and they hike that up, then even if they use part of your partial allotment to, pay down the principal or to reduce the principal balance to try to reduce payment, it's fighting against this huge, payment rising influence by jacking up the rates so much, such that you end up with, little to no payment reduction. And then if that doesn't work, you're all out of loss mit ammunition going forward with the partial claim pot. So it really is like, it's a story when you go through there, and of course, when I do these FHA loans of the day on Twitter, I'm mostly telling the entertaining story of that are
Right.
fraud, well, or people gaming the system is maybe a better way of putting it versus the tragedy. But there's a ton of borrowers who didn't know how to play the loss mitigation game. What that means, basically got what I termed a mod. And when the music stops, when the FHA's loss mitigation procedures up, then unless rates collapse between now and next February when that happens, then those borrowers, unfortunately, they're going to be saying some sort of home disposition option, either a short sale.
That doesn't seem like it should be legal that they could do a modification and put them in like a worse situation than before. Is it just like the payments just got to be reduced like $1 or something for them to really?
And they still have to offer it to the borrower. Yeah, I mean, there's tons of examples in the data. Like I wouldn't have believed that either until you see it in the data and you're like, how did that happen? And then you go and you look at what the actual mitigation rules around mods are, and they target payment reduction, of course, but there's nothing that prohibits it from happening. And the real tragedy from an FHA policy, and what makes it more, an abject policy failure on the FHA's part, is they knew, hey, doing a mod where you hike the interest rate for the longer term, unless rates again, drop precipitously in the future, then there's maybe a chance. But if they don't, it buries the borrower and neuters any payment reduction from using their partial claim funds. So they knew this. It's why they developed supplemental partial claim, which helps to address the actual problem that the borrower was facing, that, hey, they can't manage the mortgage payment right now, but they could if it actually got reduced by 25% instead of the 5% you can eke out, because you got to combat a 2.5% rise in the rate on the mod. So instead, they developed this program, but then it took a year and a half for this to really get rolled out from the time where they started planning and identifying the need for it to the time where this became like generally available, which was only in January of 2025, where servicer adoption of it was mandatory. So but it takes time to roll these sorts of programs out. And the payment supplemental is a particularly complex loss mit option for a servicer to implement. So I get that too, but just seems like, look, guide the servicers to just keep doing partial claims that don't bury the borrower for one that's generally struggling. Because if that same borrower had just said, no, I can make my mortgage payment, give me a partial claim, and done that over and over again, the one that I highlighted in the piece the borrower would be in a tremendously better position, because
their rate's not going up, they're not extending the term. Exactly. Could you maybe explain for like the layperson the kind of the difference between the partial claims versus the loan mods, what that looks like for a borrower? And then you said there's one more option now that just came out, right? That's different. The supplemental.
Yeah, the payment supplemental, sure. So partial claims kind of take a couple of different flavors of them. In general, right, the FHA is statutorily authorized to servicer as like a partial claim against guarantee prior to when they would ultimately make a claim against guarantee in a foreclosure or short sale type situation. But FHA is authorized to pay out up to 30% of the principal balance of the first claim is done, but usually pretty close to 30% of what was.
Right.
So when a servicer does what's known as a standalone partial claim, borrowers missed, 4 to 5, then what would happen if they do a standalone partial claim is basically the FHA covers those 4 to 5 missed payments. I mean, in a technical sense, they cover the arrears. It would involve both the principal and interest that was missed, and then any advances that the servicer needed to make, escrow, et cetera. That more or less correlates to just their entire payment.
And they tack it on interest-free, right, onto the end.
They do. That's what they do, right? Like and folks shouldn't misunderstand. It isn't free money in the sense of they do get it. The FHA does get a junior lien that's payable at the end of like when the mortgage matures or if the mortgage prepays. The FHA,
so the short-term cash flow is better, but when they go to sell the house or refi or something, then they're going to have to deal with that.
But it's interest-free. And if you go do a net present value on an interest-free loan for 25 to 30 years, versus the risk-free rate of what, 4.5% or whatever the 30-year treasury is at now. So in a sense, actually,
not a bad deal.
yeah, 100%. Like
Yeah.
it makes 100% economic sense for anybody who doesn't care about their credit. Delinquencies that precede the partial claim are gonna, certainly not do your credit well, but it's actually a smart financial decision, as awful and absurd a reality as that is.
A calculated decision some people make. I was curious about that. It's hard to quantify, but what percentage do you feel like of these partial claims are in the system versus people that are like legitimately having hardships?
I don't know. I don't have an aggregate sense just yet. It's something that I'm working on, but I don't have a conclusion yet. So don't want to venture a guess. There's definitely a substantial amount of both. 99.1% scenario, and I've seen enough evidence in the data of both that they're going to be a good chunk each. I just don't know whether or not that range is 80-20 one way or the other way, or somewhere in between.
Yeah, and I kind of, when I got into this, I was thinking that was kind of the story, based on your Twitter post, that people are gaming the system like PPP loans, but there's this other element where maybe uninformed borrowers are getting screwed by these modifications. Kind of interesting. And you were saying basically like if they get a mod, that could cut into their partial claim make, right? So like why would anybody take the mod? Are they just uninformed? If their rate's going up a lot?
What I surmise happened, like on the loan that I highlight in my Substack piece, what I surmise
the Arizona one?
Yeah, the Arizona one. The borrower answered honestly. So the servicer says, can you make your mortgage payment if the arrears is, or the missed payments are covered? Can you make your mortgage payment going forward? And if the servicer honestly and says yes, right? They say no, I can't.
Yeah.
Then the next step in the loss mitt waterfall for the FHA for the COVID-19 waterfall is to go and try to do a mod. And there's various flavors of mods, right? The first thing that they do is happens if we extend the term from where it is to 360, will that for the monthly payment to target of 25%? And if it won't, the term and setting the rate to market, right? So if you're doing a mod,
a lot higher.
Yeah, if you've been doing a mod for the last 2 years, if you were doing a mod in say 2021 on a loan that was originated in 2019, well, no,
that was a home run.
Yeah, you didn't need to go further than that for the most part. I mean, you drop the rate 2 points and you're going to get close to the payment reduction that you need. They can't reach the payment reduction target by extending it out to 360 and setting the rate to market. That's when they can combine that modification with a partial claim to reduce the principal on it. And then they see if that works at 360, applying as much partial claim as they have left, because the partial claim also has to cover the arrears to get the loan current. And if you max out the total partial claim pot, right, that 30% of the original balance, then and that doesn't work at 360, then they do the same thing for 480. And if it doesn't work at 480 to hit the payment reduction of 25%, ultimately the servicer still has to offer it even if it raises the payment. At this point, right? I mean, when you think about like, in equity, the servicer should really be like whispering to the borrower, being like, look, when I ask you if you can afford to make your mortgage payments, the correct answer is no. Or pardon me, the correct answer is yes. Right?
Yeah.
So you can get that standalone partial claim. But if the servicer is unwilling to go back in the waterfall, which I'm not really sure from a procedural perspective whether or not doing that if the FHA caught on, but if they don't, right? At that point, what's the borrower's choice? Accept the mod with maybe a 3% payment reduction or whatever it was in the piece, something that was a pittance. Try to beg, borrow, and steal to make the mortgage payments and stay in your home. Otherwise, the next step is loss mitt disposition, short sale or foreclosure. And for borrowers in that situation, I completely understand why they might feel like they have no other choice but to take that mod.
Yeah, and they might not really know what they're looking at there. Their rates going up, they're going to a 40-year term. Have to be Like be a worse deal there. That's really unfortunate. And is this something that you think with maybe the new administration they're going to keep having the same policy, or do you think there might be some changes in this going forward?
I don't know. I don't legitimately have a sense of it, right? And I'm kind of watching this new administration with the same curiosity as everybody else. With respect to the COVID waterfalls, it was originally set to expire in April and be replaced with the FHA HAMP version, which is significantly tighter. And it's not that different from being tight as the procedures that will replace the COVID-19 in February 2026. But that extension then from April 30th to February 2nd, 2026, the FHA did that in a mortgagee letter that they issued on January 16th, which is interestingly 4 days before the administration's changed.
Yeah.
The Trump administration right now, is the FHA in any event, is still on the course that has been set for it by the prior administration. Will they change it? I mean, if they do, if they accelerate the end of this, then let it go on for another year. If rates collapse between now and then, I certainly think that this administration would like long-term rates to come down. Some of those mods are still gonna in disposition of some sort, but some of them will have a much better shot if
even 5% rates, the last couple of years would help people with mods. It sounds
for sure. Choice for them. I don't know what because if it doesn't happen and rates aren't down by February 2026, then you just have an even bigger problem on your hand, because you're enabling the nonsense that I highlight daily in the FHA loan of the day to continue for another year.
John, what would you say to somebody that's like watching this that has an FHA mortgage that's maybe thinking about like, hey, you know what, I kind of want to play the partial claim game and game the system a little bit?
Everybody has to make their own decision for what they do. The rules allow for it. I would encourage borrowers has to make their own choice.
They are going to wreck their credit, right?
I'd certainly encourage them not to falsely attest to anything, because there are attestations that have to be made about ability to make the mortgage payment. As I wouldn't encourage them to do it. I mean, it's right. I think it's the wrong thing to do.
Yeah.
But I would understand, some borrowers are in economic situations where, they may feel like that's.
I mean, these FHA payments that we're seeing now, a lot of them are like, $7,000, it's not like the COVID era, payments.
To be entirely clear, I highlight many of these higher dollar value ones because they're entertaining, right? Most of the FHA portfolio isn't at these sort of levels of stratospheres. I mean, most of the FHA portfolio are lower. It really, but dollar ski home and that makes for better.
More entertaining. Right? John, where could people find you if they want to, find out more about this stuff?
Oh, sure. Yeah. They can follow me on X, 77. That's at JohnComiskey 77. Or they can subscribe to my Substack, which